Ever wondered why the Federal Reserve hasn't cut interest rates despite widespread calls and political pressure? It's a complex question with deep economic implications, especially for business students like you. Let's dive into the Fed's decisions and the forces at play. The Federal Open Market Committee, FOMC, decided to keep interest rates steady, resisting calls for cuts. This decision comes despite criticism, including from former President Trump. Understanding their rationale is key. The US economy started 2025 in robust health. Manufacturing output hit an all-time high in late 2024, and investment in the sector surged. Recession probability was at a 3-year low, indicating a strong economic foundation. The Fed's primary mandate from Congress is threefold: maximize employment, keep inflation low, and maintain moderate long-term interest rates. Their decisions are guided by these core objectives, not political whims. Current economic indicators suggest the Fed's mandate isn't screaming for a cut. Unemployment in June was a modest 4.1%, close to historical lows. Headline inflation, at 2.7%, remains stubbornly above the Fed's 2% target. The Fed's real policy rate is currently near neutral. This means monetary policy is neither aggressively stimulating nor significantly restricting economic activity. It's a balanced stance, given the current conditions. President Trump asserted that the FOMC is costing the US government trillions. However, keeping government borrowing costs low is explicitly not part of the Fed's mandate. Adding this would be disastrous. History shows that when central banks are forced to keep rates low for high-spending governments, the results are terrible. Households, businesses, and markets suffer, often taking decades to recover. The yield on US government 10-year bonds is roughly where it's been since late 2022. The Treasury faces similar borrowing costs to those seen during the previous administration. A more direct way to lower US government borrowing costs is simple: issue less debt. Cajoling the Fed to lower short-term policy rates is not the solution. Americans do face economic challenges. Labor markets have cooled, with fewer job postings per seeker. Changes in immigration policies are also dampening economic activity and growth. Wage gains are slowing, while prices remain significantly higher than pre-pandemic levels. Tariffs are now beginning to pass through to consumers, potentially accelerating inflation further. If the Fed were to cut short-term rates, it's not guaranteed mortgage financing costs would decrease. Mortgage rates are benchmarked off 10-year US Treasury yields, which could rise if inflation concerns mount. Many experts, including Professor Brett House, don't foresee or recommend a rate cut in 2025. None of the Fed's three mandates would be more clearly fulfilled by lower policy rates. However, the FOMC itself anticipated 2 cuts this year in its June projections. Markets are still pricing in at least 1 cut, and the consensus among forecasters expects a reduction. 2 Fed governors even dissented from the July 30th decision, voting for a quarter-point cut. This highlights the internal debate and differing views within the committee. Further political meddling with the Fed's independence would be a slow-moving disaster. Such actions would severely roil financial markets and erode faith in US institutions. It would also push up inflation expectations and raise US Treasury yields. This would make borrowing more expensive for Americans at longer maturities, hurting the economy. Ultimately, political interference would make it harder, not easier, for the Fed to deliver the lower short-term policy rates some desire. Independence is crucial for stability. Understanding the Fed's complex role is vital for any aspiring business leader. Their decisions are not arbitrary, but are rooted in a clear mandate and economic data. If you found this breakdown insightful, hit the like button and subscribe for more in-depth economic analysis. Share your thoughts in the comments below. Do you think the Fed should cut rates?